In 1907, the panic began. Two men made one mistake, and the entire market paid the price. Here's why.
On a calm autumn morning in '07, citizens went about their lives unaware the nation's financial system was beginning to crack beneath their feet. Without warning, banks across New York shut their doors, freezing withdrawals and leaving ordinary citizens suddenly locked out of their own money. Inside the banks, clerks quietly refused withdrawals, transforming savings accounts into useless numbers and turning trust into instant suspicion.
Rumors moved faster than fact, spreading fear through the streets as trust in the financial system began to evaporate. Behind closed doors, bank officials spoke in whispers, offering no explanations while the
lines stretched around city blocks as Americans raced to withdraw whatever money they still believed might exist. Behind the stone walls and steel doors, banks held far less cash than anyone had ever imagined. New York stood frozen, unsure whether its financial heart would keep beating or collapse entirely.
What began as quiet uncertainty exploded into full-scale panic, shaking the foundations of American finance.
As fear reached Wall Street, markets began to convulse, sending shockwaves through every corner of the American economy.
Interest rates surged beyond comprehension, climbing from single digits to nearly 100%, signaling total distrust between financial institutions.
At the height of the panic, money simply stopped moving, as lenders refused to risk a single dollar. Commodity prices collapsed by more than 20%, choking industries that depended on stable markets to survive. With credit gone, factories shut down, and machines that once powered prosperity fell silent. Bankruptcies surged nearly 50%, wiping out small businesses and decades of hard-earned work. Unemployment tripled in months, leaving millions without income as uncertainty consumed everyday life. Newspapers carried the panic nationwide, spreading fear from city centers to the smallest towns.
In just days, a financial scheme had become a national catastrophe, leaving America stunned and uncertain about what would come next.
At the dawn of the 20th century, America expanded at breathtaking speed.
Unlike Europe, the United States had no central bank, no safety net, and no coordinated response to financial emergencies. Trust companies flourished by holding massive deposits while keeping dangerously small cash reserves. Many trust companies held only 5% of deposits in cash, leaving them dangerously exposed to panic.
Trust companies fueled Wall Street through overnight call loans, a system that collapsed the moment confidence disappeared.
The entire system depended on confidence, and once trust cracked, money itself lost its meaning. In 1906, the San Francisco earthquake delivered a shock that rippled through the global financial system.
Insurance payouts drained gold reserves, forcing European banks to tighten credit worldwide.
As credit tightened, America's fragile financial structure moved closer to collapse.
By 19, financial justice system stood stretched thin.
At the turn of the century, copper-powered electricity, communication, and industry, mauling it one of the most valuable resources on Earth.
In Montana, copper wealth transformed a remote frontier into one of America's most violent and...
A single corporation, Amalgamated Copper, crushed competitors and ruled Montana's mines with near-total authority.
Into this ruthless world stepped Augustus Heinze, a man who saw monopolies not as obstacles, but as targets.
Heinze buried his rivals under hundreds of lawsuits, draining their money and time through endless legal battles. While courts argued above ground, Heinze's miners tunneled beneath rivals' claims, stealing millions in high-grade ore.
By twisting Montana's apex mining law, Heinze convinced courts that stolen ore legally belonged to him.
As scrutiny increased, courts reversed course, and Heinze's once-protected schemes began to unravel.
In 1906, Heinze sold his mining interests and left Montana, carrying ambition toward a far more dangerous battlefield.
Heinz's arrived in New York, where financial power, not pickaxes, would determine the fate of nations. Unlike frontier barons, Charles Morse ruled through calculation, manipulation, and an instinctive understanding of power. From a young age, Morse learned he could profit more from manipulation than honest labor.
While still a student, Morse profited by shipping massive blocks of ice to cities desperate for refrigeration.
Morse maximized profit by ensuring his ships never returned empty, turning logistics into an engine of wealth. Before graduation, Morse had earned the modern equivalent of millions, reinforcing his belief in manipulation over merit. Morse systematically absorbed rival ice companies, forging an empire that controlled nearly all ice on the East Coast. The press crowned him the Ice King, unaware that deception and corruption powered his frozen empire. With wealth secured, Morse turned toward finance, quietly taking control of powerful banks and trust companies.
Through banks and trusts, Morse quietly pulled the strings of New York's financial system.
Two men, driven by ambition and greed, were now moving toward each other on a collision course with history. Each saw in the other a reflection, bold, reckless, and willing to break rules for extraordinary reward.
With Morse's backing, Heinz quickly recovered from his losses and re-entered finance with renewed power.
Through layered ownership and influence, the two men quietly controlled banks without ever appearing in charge.
By 1907, Heinz held sway over 6 national banks, concentrating power few understood or questioned.
10 state banks and numerous trust companies quietly joined their growing financial web.
Even insurance firms became part of the scheme, multiplying leverage across an already fragile system. To the public, everything appeared stable, unaware how tightly the system had been wound.
Flush with power, the two men believed they could bend markets themselves without consequence.
Their next move would attempt to manipulate an entire stock market and ignite catastrophe.
Among thousands of stocks, Heinz and Morse fixated on one, United Copper, believing it held the key to limitless profit.
Many traders had bet against United Copper, expecting its price to fall and planning to profit from its decline.
Otto Heinz proposed a simple trap: buy every available share and force short sellers to pay any price.
If successful, the squeeze would force desperate traders to buy at inflated prices, delivering enormous profits.
Heinz and Morse began buying aggressively, racing to corner the market before anyone realized the trap. The plan demanded enormous capital, far more than even their combined fortunes could supply alone. For funding, they turned to trust companies, institutions lightly regulated and dangerously exposed to sudden shocks.
Their gambles soon depended on one institution more than any other: the Knickerbocker Trust Company.
Led by Charles T. Barney, Knickerbocker's leadership agreed to support a gamble they barely understood.
With funding secured, the trap was set, and there would be no turning back.
On October 15th, 1907, the markets opened, and the fate of a reckless gamble was finally tested.
Instead of rising, United Copper collapsed, destroying the scheme in a single catastrophic trading session.
Short sellers found unexpected sources of shares, slipping free from the trap Heinz believed he controlled.
Fortunes vanished within hours, leaving brokers and investors stunned by the speed of collapse.
News of the failed scheme raced through the city, quickly linking banks and trust companies to disaster. At first, withdrawals were quiet, but beneath the surface, fear was already accelerating. What began as a trickle of withdrawals quickly became a flood, draining trust companies at terrifying speed.
In just hours, Knickerbocker Trust paid out millions, emptying reserves faster than anyone believed possible.
By early afternoon, Knickerbocker Trust closed its doors, sealing the fate of one of America's largest institutions. The collapse of Knickerbocker Trust unleashed a full-scale financial panic that no one could contain.
Fear leaped from one institution to another, as depositors rushed to withdraw funds from any trust they distrusted.
Terrified of collapse, banks hoarded cash, pulling reserves out of Wall Street and starving markets of liquidity. At the peak of panic, interest rates briefly reached 100%, a sign that money itself had stopped flowing.
With credit frozen, trading slowed to a crawl, leaving Wall Street eerily silent.
Without credit, businesses could not function, triggering closures that rippled through the real economy.
Factories shut their doors as financing vanished, turning economic panic into mass unemployment.
Bankruptcies soared nearly 50% as companies collapsed under the weight of frozen credit.
Unemployment surged as millions lost their livelihoods in a crisis they never caused.
With no central bank, the nation stood exposed.
As the panic deepened, Wall Street turned to one man with the power and will to act.
Inside his private library, J.P. Morgan gathered the most powerful men in American finance. The doors were locked, declaring no one would leave until a solution was reached.
Morgan organized an emergency rescue, injecting millions to stop another devastating bank run.
For hours, financiers argued, each fearing the cost of saving the system.
Morgan organized an emergency rescue, injecting millions to stop another devastating bank run.
A massive market rescue fund stabilized stocks and eased the suffocating interest rates. Yet Morgan refused to save Knickerbocker Trust, allowing it to fail as a warning against reckless behavior. Gradually, confidence returned, and the worst of the panic began to loosen its grip.
In the aftermath, 2 disgraced financiers were expelled from New York banking, their power abruptly extinguished.
Augustus Heinz spiraled into addiction and despair, drinking himself to death by night and fortin.
Otto Heinze vanished from Wall Street, his ambitions buried beneath the ruins he helped create.
Charles Morse was convicted of federal banking crimes and sentenced to 15 years in prison.
Charles T. Barney, disgraced and broken, took his own life, another casualty of reckless ambition. Behind bars, Morse befriended Carlo Ponzi, unknowingly influencing one of history's most infamous con artists.
Morgan's intervention raised alarming questions about private power over the national economy.
The Panic of 1907 directly led to the creation of the Federal Reserve in 1913.
From 1907 to 2008, financial crises followed eerily familiar patterns.
Unchecked ambition can collapse nations, proving that financial history does not repeat, but it always rhymes.